Good morning and welcome to the Global View on this Friday. I'm Andrew Gagan. Great to have you with us here at AusBiz. Let's get across the action overnight. Global equities sharply lower, with oil prices surging to their highest level in nearly 4 years as Iran intensified its attacks on oil and transport facilities across the Middle East, while the country's supreme leader has vowed to keep the Strait of Hormuz shut. On Wall Street, the major indices fell heavily, with spiking oil prices unnerving investors amid heightened inflation fears. Wells Fargo saying it expects new US economic projections to be released next week will shift in a stagflationary direction. Well, shares of US energy companies rose, tracking crude prices higher. ExxonMobil, Chevron and Conoco among those to benefit. Agricultural fertiliser firms, which also rely on shipments through the Strait of Hormuz, advanced on surging prices. The brokers have cut the price target on US airlines after jet fuel prices jumped about 50%, which will squeeze profits because fares were set assuming cheaper fuel. Chemical companies advanced, following a Citigroup upgrade there on new export opportunities arising from supply chain disruptions in the Middle East. The shares of alternative asset managers slipped after Morgan Stanley limited redemptions at one of its private credit funds, while JP Morgan Chase has restricted lending to private credit providers after the bank marked down value of certain loans in the firm's portfolios. Dating app operator Bumble jumped after its fourth quarter revenue guidance came in above estimates, and discount retailer Dollar General slid following disappointing annual comparable sales forecasts. Well, in his first public statement since becoming Iran's supreme leader, Mojtaba Khamenei has vowed to keep fighting and to keep the Strait of Hormuz shut as leverage against the United States and Israel. He also called on Iran's neighbours to shut US bases on their territory and warned that Iran would continue to target them, saying, "I assure everyone that we will not neglect avenging the blood of your martyrs." Well, in response, Israeli Prime Minister Benjamin Netanyahu issued a veiled threat to Khamenei, saying, "I wouldn't issue life insurance policies on any of the leaders of the terrorist organisation." Meanwhile, the Trump administration is considering waiving the century-old Jones Act for a limited period to ensure energy and agricultural shipments can move freely between US ports. Under the Act, goods shipped between US ports must be carried on vessels that are US built, flagged, and mostly US owned. 2-year Treasury yields have hit a 6-month high as Iran ramped up the attacks on energy and transport targets in the Gulf. The 2-year up more than 11 basis points to 3.76. The 10-year US Treasury rising to 4.27. Australian 3-year government bond yields at around 4.58%. The 10-year is at close to 4.98%. The US dollar index up around 0.5% on the day. The Aussie currently at 70.8 US cents. Well, the International Energy Agency estimates that the Middle East war will slash global oil supply by 8 million barrels a day this month, or almost 250 million barrels in total. It says flows through the Strait of Hormuz are down by more than 90%. Well, Brent futures settled at around $100 a barrel, up more than 9%, after touching a session high of close to 102 a barrel. Gold has fallen close to 2%, weighed down by a stronger US dollar and fading hopes of further rate cuts. Spot gold around $5,060 an ounce. And copper was down, iron ore surging more than 3.5% to 110 US dollars a tonne amid rapidly rising global trade costs. And Bitcoin little changed, sitting above 70,000 US dollars. Let's get across those global moves. David Scutt joining us from StoneX. Scutty, welcome. Now, of course, oil continuing to have reverberations across all markets at the moment, and that was another significant move that we saw overnight. What are you watching in particular?
Good, Andrew. Great to be back. Yeah, obviously, oil price is very important, but more so in my world, I'm looking at what's going on at the front end of the US Treasury curve, particularly when it comes to money markets as well, and just the sharp repricing of Fed rate cut expectations this year that we've seen, because that's now starting to become a bigger talking point rather than what's going on with crude and what's going on with the energy supplies. And what we've got now is that markets have pared rate cut pricing for the Fed this year down to just 17.5 basis points. So it was sitting at 60 at the start of this month. And that's leading to this big uplift we're seeing in Treasury yields. And it's not been driven by increased growth anticipation. It's been driven by inflationary concerns, which is a concern for broader markets, particularly cyclical areas that have run really hard this year.
And what are you seeing locally as well in terms of where those bonds are moving at the moment?
Yeah, locally it's very interesting. The RBA, the pricing's come back a little bit when it comes to what they're expected to go and do next week. Still about a two-thirds probability of a hike coming through. But yeah, just looking at locally, the local market, it does kind of feel a little bit vulnerable out there at the moment. I'm particularly concerned about those domestic, household-facing, business-facing parts of the other market. Just given what we're talking about with fuel security at the moment, looking at what's going on with wholesale gasoline prices coming out of Singapore, what's going on with diesel prices, all of that's going to start to go and impact demand. So those cyclical parts of the local market, discretionary in particular, I think will be very vulnerable the longer this crisis extends for.
Do you think that's a consideration from the RBA? Well, obviously it is a consideration, but the effect of rising fuel prices as it feeds in across the entire economy, likely to drag obviously on economic growth. And that leads to obviously the point about stagflation. In fact, I was mentioning there earlier, Wells Fargo, as far as the US economic projections are concerned, saying it will shift into a stagflationary direction.
It is, and this is the really uncomfortable factor as a policymaker trying to go and juggle here. What do you go and target? The issue that the RBA has always had, in the last few months at least, is that Australia has been running inflation rates that are well and truly above acceptable levels, and we're sitting at what levels are deemed to be above potential. So buffering up this strong demand that's coming through from various parts of the economy, both from the private and the public sector. And it's just leading to this inflationary pulse. And when you start throwing on top of that big increases coming through on energy, which filters through very quickly to other areas, costs get passed on. It becomes self-sufficient and self-fulfilling in terms of what it means through the inflationary pulse. So at this point in time, if the RBA had a bit of spare capacity, it could go and work with the economy. Inflation was less tame, they could probably look through it. But it makes it very difficult for them to go and do at this point in time. We've seen for a long period of time, bar a quarter or two, that underlying inflation has been at unacceptable levels and above target.
Scotty, how's this playing out with currencies? Obviously, we're seeing that safe haven play. Given bonds are not working, are investors seeking the safe haven of the US dollar?
It is, and it really is truly acting as a safe haven on this occasion. I did some research on this yesterday, and whilst it's energy-led and initiated this move, what we've seen over the past week at least is that the dollar has been really sought out. It's because yields are going up and growth expectations in the States, while they've come off the ball a little bit, haven't really killed over at this point in time. So that's really supporting this inflow into the US dollar. Positive term of trade shock that's coming through there, like for Australia, but just magnified in significance when it comes to the States. So that's really been the driving factor. And then with the Aussie dollar, it got crunched a little bit overnight. And that was really on what's going on at the front end of the curve. That Fed repricing is having a big impact on those cyclical areas of the market, including cyclical currencies.
What do you make of alternative so-called safe havens, I guess? Gold clearly is not reacting perhaps as it should, particularly in times of heightened geopolitical risk. Whereas
Yes.
Bitcoin is actually fairly stable at the moment.
It is. Obviously had various differing paths over the months before what's been going on. But you're right. Gold is an interesting one. It's really been infiltrated by a lot more retail participation, and a lot of people who I assume would have probably been previously active in the crypto space have actually gone and shifted across. So you're right. It's not behaving like a classical safe haven by any stretch of the imagination, nor are treasuries. It really is just a US dollar story and energy asset story when it comes to safe havens in this environment. As to will gold eventually go and revert to its historical trend? I suspect so, but you probably need to go and see a lot of that speculative activity that's really been built up in that market over the past year or so. Really start to go and unwind. A bit of pain there, and then we might get back to maybe some of those more traditional drivers like interest rates, like the US dollar and safe haven bids.
Scotty, with no obvious off-ramp for Donald Trump, the US, to extricate themselves from what's going on right now. We're 2 weeks in to this war, and obviously Iran is doubling down. Are markets, particularly those risk asset markets, just waking up? In fact, investors just cottoning on perhaps the fact that this is likely to be very protracted.
I think so. I think there's still a glimmer of hope out there that we'll get a taco moment or something like that. But I think what we've seen over the past week is that it takes two to tango. And at this point in time, this is not something that Donald Trump can solely go and solve on his own. Iran has to go and agree as well. And at this stage, you said it doesn't really look like it. Lots of attacks still ongoing overnight in the Gulf, around the Straits. So it's difficult to go and see an off ramp, as you said. And so when you talk about what the implications are for investors and things like that, the areas that I'm concerned about, much like the local market and the domestic facing cyclical parts, those markets that really ran hard earlier this year on this diversification trade away from the US, and I'm talking about Europe, I'm talking about parts of Asia, those real cyclical markets that are really heavily energy intensive users, they look really vulnerable to me. And when you have people like the US Energy Secretary talking about, oh, we might be able to go and escort ships through by the end of March, that's 16 days away, 17 days away. The longer this draws out, the more vulnerable those cyclical names become. So to me, if you're sitting on a nice profit, you've had a good run there, it wouldn't be a bad time to go and take some off the table and just see how this plays out, because it doesn't look like it's going to go and end anytime soon. And even if it does, supply normality coming back to the market is going to take a long time as well.
Yeah, certainly estimates that it would take at least 6 months to get oil supply back to where it was before the conflict began. Scotty, great to catch up. Thanks for joining us from StoneX.
Great to be here.
All right, let's turn our attention to the local market. Just ahead of the open, though, we are expecting a lower start, reflecting on what we saw on global markets overnight. So S&P ASX 200 there, futures down around 0.33%. We'll get across it all in just a couple of minutes with the open. Stay with us.